on China's recent easing of foreign strategic investment regulations. Here's a recap of everything we included in that essay. Title, China's Strategic Investment Reforms in the Asia Market, Implications and Global Comparisons. Abstract, we started with a summary of how in late 2024, China overhauled its regulatory framework to encourage more inclusive and diverse foreign investment in listed companies, aiming to make China a more attractive global financial hub. Introduction, we discussed the context of these reforms, noting that they come at a time of global economic uncertainty, geopolitical tensions, and a decline in foreign direct investment in China. The new measures, effective from December 2nd, 2024, represent a significant shift from the previous restrictive regime. We detailed the old investment regime, which required Ministry of Commerce approval for all foreign investments and only allowed legal entities like multinational corporations to participate. The thresholds were high and the lockup period for investments was 3 years. Key changes, the new measures include allowing individual foreign investors, not just companies, lowering the asset thresholds from $100 million to $50 million and from $500 million in assets under management to $300 million, introducing tender offers as a new investment method, and reducing the lockup period from 3 years to just 12 months. The measures also allow for the use of equities from non-listed overseas companies as consideration in investment deals. Policy objectives, these changes aim to attract high-quality foreign capital, restore investor confidence, increase market liquidity, and support domestic industrial growth. Regulatory streamlining alongside easing restrictions, the reforms also ensure stronger oversight, requiring compliance commitments, coordination with anti-monopoly and national security reviews, and increased responsibility for intermediaries. Global comparisons, we compared China's reforms to the U.S. model, noting that while the U.S. market is more decentralized and transparent, China's reforms bring it closer to global standards of openness and investor diversity. Challenges and risks, despite the positive changes, challenges remain, including geopolitical tensions, regulatory unpredictability, and sector-specific restrictions that still exist. We concluded that these reforms mark a significant liberalization of China's capital market policy, potentially setting the stage for China to become a leading global financial center if the reforms are implemented consistently and transparently. Bibliography, we included sources from Norton Rose Fulbright, Global Times, China Briefing, the U.S. Department of State, and other reputable sources. Let me know if you'd like to dive deeper into any specific section or if there's anything else.
Sure. So, okay. Now, my question is, and it's a little bit, a few. The first thing is, are there current capital controls in China today in terms of how liquidity moves?
Yes, China does still maintain capital controls today. These controls are designed to regulate the flow of money in and out of the country, ensuring financial stability and managing the exchange rate of the yuan. For example, there are limits on how much currency individuals can move abroad, and companies also face regulations on foreign exchange transactions. These measures help the government manage liquidity and protect against potential financial risks.
So I know that they want to get very high credible investors that have a lot of money, not just regular people, like me, who will just go on Robinhood and buy, maybe $200-300 in shares. This is billions or trillions of dollars of capital they want. It's very obvious. The question that I have for you is going to be, to what entities around the world do you think would be interested in investing in this?
You're absolutely right. China is definitely aiming to attract large institutional investors and sovereign wealth funds with these reforms. Some of the key entities that would likely be interested in investing in China's A-share market include sovereign wealth funds. Entities like Norway's Government Pension Fund Global, the Abu Dhabi Investment Authority, and the China Investment Corporation itself are always looking for stable long-term investment opportunities. Global asset managers, firms like BlackRock, Vanguard, and Fidelity, manage trillions in assets and continuously seek to diversify their portfolios with emerging market investments. Pension funds, large pension funds from countries like Canada, the Netherlands, and Japan are always on the lookout for stable long-term growth opportunities. Hedge funds and private equity, these entities, especially those with a focus on Asia, would be interested in tapping into China's growth potential, particularly now that regulatory hurdles are easing up. And multinational corporations, large companies that have strategic interests in China, might also invest in listed firms to strengthen their foothold in the Chinese market.
So, in all actuality, what industries do you think they would allow capital in? Now, when we wrote the essay, it was definitely explained that there would still be limits, and then there would have to be national security risk reviews. I know that America does, in fact, do the same thing. Napalm Steel, please correct me if the first part of it, was wrong. They wanted to buy U.S. Steel. They came in, Trump with his this is against national security interest, type attitude. So in all actuality, would China follow the same route?
Yes, you're absolutely right about how national security concerns play a role in both the US and China when it comes to foreign investments. In the US, the Committee on Foreign Investment, CFIUS, reviews foreign investments for potential national security risks. The Nippon Steel and US Steel situation is a good example of how these reviews can influence or even block deals if they're seen as a threat. China similarly has a framework for reviewing foreign investments in industries that are considered sensitive. Typically, sectors like defense, telecommunications, energy, and other critical infrastructure are subject to strict scrutiny. While China is indeed opening up more industries for foreign investment, they still maintain a negative list, which outlines sectors where foreign investment is either restricted or prohibited. So in reality, China is likely to continue allowing capital inflows into industries like technology, renewable energy, manufacturing, and consumer goods, while keeping a tighter grip on sectors that impact national security or core infrastructure.
Okay. How much money over the next 5 to 10 years can we predict this change will have on the economy?
Predicting the exact financial impact of these regulatory changes on China's economy over the next 5 to 10 years is a bit complex, but we can definitely consider some projections and factors. With these
So
new regulations,
okay, hold on. So why don't we just turn around and build a framework that would be like the following? Let's look at the overall percentage of actual foreign investment within the country. And let's just say over a period of time, they can get between 1 to 5% a year. What I would recommend is a regression period, at least representing a recession for a period of time. I think China's economy is a little bit more unique because they always throw a constant stream of stimulus into it to continue to allow it to grow bigger. But if there is some sort of a way we can get those percentages, we could be able to make a very simple model, look at the change and the rate within GDP when measuring this.
absolutely. Building a simple model to measure the potential impact of increased foreign investment on China's GDP over time is a great idea. If we assume that foreign direct investment, FDI, could contribute an additional 1% to 5% annually in terms of capital inflow, we can then tie that to GDP growth by looking at how FDI historically impacts economic growth. Generally, FDI boosts not only capital formation, but also technology transfer, job creation, and productivity improvements, which all feed into GDP growth. To create a simple model, we'd start with China's current GDP and its average growth rate, then add a variable for the additional FDI percentage each year. We could also factor in a potential recession period, as you mentioned, where growth might slow down or even contract. By modeling these variables, we can get a rough projection of how much additional economic growth might be fueled by these reforms. It's a fun exercise in economic forecasting.
All right, well, let's go ahead and do that.
Absolutely. To give a bit of context, if China successfully attracts more high-quality foreign investment due to these relaxed regulations, we could see several potential impacts. One, increased foreign direct investment. Even a modest increase in FDI can translate to tens of billions of dollars flowing into China annually. For example, if China boosts its FDI by even 10 to 15% annually, that could mean an additional 15 to 25 billion each year, given that recent FDI figures were around 163 billion in 2023. Sector-specific growth, industries like technology, renewable energy, and advanced manufacturing are likely to see significant growth as foreign investors bring in not just capital, but also technology, expertise, and global connections. This can lead to innovation, job creation, and more robust economic growth in those sectors. Long-term economic stability by attracting strategic long-term investments. China can also help stabilize its currency and financial markets. This might lead to stronger economic growth projections over the next decade, potentially pushing China's GDP growth rates higher than some of the more conservative forecasts. Of course, these projections depend on broader global economic conditions and how consistently China implements these reforms, but the potential for a significant positive impact is definitely there.
So what dollar amount would? Okay, sorry. Hold on. Let me scratch that. Every $1 trillion, what percentage could that change the GDP? Let's try to pull up some figures.
No worries. To give you a rough idea, let's break it down with some figures. China's GDP in 2023 was around $17.7 trillion. If we consider an additional $1 trillion in foreign investment over a decade, that would be about $100 billion per year. If we assume that $1 trillion of investment translates roughly into a direct addition to GDP, keeping it simple, that would be an increase of about 5.6% of the current GDP. Of course, in reality, the effect would be more complex since investments drive growth through multiple channels like job creation, productivity improvements, and increased consumption. In short, $1 trillion influx could lead to a several percentage point increase in GDP over time, contributing to overall economic growth and development.
Okay, I'll ask you one more question. If they were able to increase that by several points using the current GDP, and if 7% were added today, how much in a dollar amount would that equal? With the whole percentage.
If we take China's current GDP of around $17.7 trillion and consider a 7% increase, we can calculate the dollar amount of that increase. First, let's find 7% of 17.7 trillion. 7% of 17.7 trillion is approximately $1.239 trillion. So if China's GDP were to increase by 7% today, it would add roughly $1.24 trillion to the economy. That's a substantial boost and gives a sense of how impactful even a few percentage points of growth can be on such a large economy.